The lenders will want to make a return on their debt, but unlike project sponsors, they will not share in any upside if the project performs better than expected. The lenders will also want to ensure that their debt will be repaid in accordance with the agreed repayment schedule. Therefore, the lenders will want to ensure that the project will be completed on time, that the project company will earn the anticipated income stream, and that the project company will not incur liabilities, costs, and expenses over and above those that have been budgeted for. Lenders will also want to be able to have control over key decisions without incurring any liabilities, for example, as a shadow director, and they will want to have the right to step in to try to save the project if things go wrong. In other words, they want to have step-in rights. Lenders will also not want the sponsors to be paid a dividend or similar distribution when there is a default or before the first capital repayment of the loan has been made. And this is also another hotly negotiated matter, because the lenders will want any revenue that the project company earns before the end of the construction phase to be used to pay the project company's expenses and not to pay sponsors dividends. The rationale for this is pretty straightforward, because the repayment of debt should reduce the project company's needs to borrow, so overall borrowings are kept to a minimum. And the lenders will also wish to see that any surplus cash that the project company earns is used to prepay loans rather than to pay dividends to the sponsors. And this is usually achieved through a so-called cash sweep mechanism, which will provide and state that any excess cash flows have to be used to pay down outstanding debt rather than being distributed to shareholders, to sponsors. I think it's important to also talk about bank accounts, because financing documentation would provide either in the loan agreement itself or in a separate document for the establishment of specific bank accounts relating to the borrower's receipts and expenditures. And the various controls would be imposed as to the payment into and withdrawals and transfers from those accounts. Such accounts are commonly referred to as control accounts. And in most cases, control accounts would be held by a bank in one of international financial centers, but the borrower may be permitted to maintain an account with a local bank in its place of operations in order to be able to deal with local currency, expenditure, and receipts.